Most corporate fraud, well, it doesn't look like a crime. On paper, it looks like a flawlessly run business. Contracts are signed, balance sheets carry all the right disclaimers, filings sail right through automated reviews. But perfectly compliant paperwork is often the exact thing hiding a completely different operational reality underneath. So ask yourself this directly. If your oversight only checks whether documents are internally consistent, are you actually checking if they're true? That right there is the central evidentiary problem facing boards, compliance teams, and investigators today. Because when the paperwork is flawless, traditional red flags just disappear.
Today, we're breaking down this problem. We'll cover the blind spot of compliance, look at the anatomy of a composite case, and examine 3 patterns of concealment. Then we'll talk about forcing systems to argue, calibrating the evidence, and finally, actions for oversight.
All right, part 1. The blind spot of compliance.
This massive evidentiary gap exists because standard oversight relies way too heavily on static audits. Now, a static audit just checks documents against other documents. Think about it. If a payroll filing matches a signed employment contract, the static audit registers a success. It's compliant, it's low risk, and honestly, it's boring. But operational reality, the actual physical movement of people and the unseen financial movement of capital, that exists completely independent of the paper trail. The blind spot lives exactly in that space between what's written down and what's literally happening on the ground.
Let's move to part 2, the anatomy of a composite case.
To ground this, let's look at a composite scenario based on a regional retail franchise. They operate through 2 distinct entities. First, you have Entity A, the local operating company. They handle the storefronts, the day-to-day management, and standard payroll. Then you have Entity B, a related holding company registered in a lower tax jurisdiction. Technically, sure, they are separate legal entities, but practically, they share the exact same ownership. And what the structure does is it allows one single paycheck to be split in half, making the complete financial picture virtually invisible to any single regulator. Now, it's really critical to point out here that there is nothing inherently illegal about this corporate structure. Legitimate, highly regulated businesses use multiple entities across different jurisdictions every single day. The fraud wasn't in the structure itself, it was in what moved through it and how that movement was deliberately concealed from static audits.
Which brings us to part 3, 3 patterns of concealment. Looking through the lens of this multi-entity structure, we start to see very specific patterns of concealment. Pattern 1 involves ghost workers, people who just didn't exist on paper. In our composite scenario, store managers were actively running daily operations. They were handling cash, managing vendor relationships, operating security systems months before formal employment contracts were ever signed. So when a labor inspection eventually happened, the company just handed over backdated contracts, perfectly timed to match a minimum wage filing. The inspectors checked the notarized paper, saw no discrepancies, and just moved on. They completely missed the operational reality because they didn't check the physical security alarm logs, which would have shown those exact same managers disarming the doors every single morning.
Then we have pattern 2, the split paycheck. Entity A declared a modest, highly plausible base salary to local pension and tax authorities. Meanwhile, Entity B was quietly transferring the rest of the compensation directly into personal accounts. These secondary transfers were very carefully labeled as a bonus or incentive so they wouldn't look like recurring wages. And because pension systems only ever saw Entity A's compliant filings, they were totally blind to Entity B's massive recurring transfers.
And pattern 3 is your classic 2 sets of books. The full daily sales were logged internally on a restricted spreadsheet, something seen by only a handful of people. The version that was actually sent to official tax authorities was a mere fraction of that. It was enough to look plausible, but roughly half of the gross revenue just never made it into the official filings. External accountants signed off on it, naturally, using standard liability disclaimers stating the audit was prepared based on information provided by the client. The accountants stayed legally protected, while the business owners maintained total control over the untaxed cash.
That takes us to part 4, forcing systems to argue.
Static audits fail to catch these patterns because the paperwork is internally consistent. What actually exposes these operations is a specific framework. You have to force unrelated data sources to argue with each other. Step 1. You cross-reference access logs against contracts. When you do, you see that physical presence in the building simply doesn't match the start dates on the paper. Step 2. Compare bank metadata against pension filings. Suddenly, recurring transfers labeled bonus statistically match a standard payroll schedule, not some sporadic incentive. Step 3. Map those internal digital ledgers against the official filings. The financial gap becomes too large and way too structurally consistent to be a simple accounting error. You see, paperwork can easily be backdated. Digital access logs and bank metadata? Generally, they cannot. Next up, Part 5, Calibrating the Evidence.
When we uncover these kinds of structural discrepancies, we have to apply rigorous discipline to how we interpret them. In digital forensics and corporate investigations, we clearly distinguish between 5 distinct layers of evidence. First, you have the observable artifact, say a single line of code in an alarm log. Second is the authenticated technical fact. User code 402 disarmed the front door at 6 a.m. for 90 consecutive days. Third, we have the analytical inference. Based on that data, the store is being actively managed by that individual prior to their contract date. Fourth is the unresolved hypothesis. Maybe the company intentionally delayed signing contracts to evade wage and pension taxes. And finally, the 5th layer, the legal determination, fraud.
It is absolutely paramount to understand what digital evidence can and cannot establish. Cross-domain data establishes severe operational discrepancies. It proves that the paperwork does not match the physical or financial reality. But it cannot establish automatic proof of intent. It doesn't automatically prove guilt, and it definitely does not make a legal determination of fraud. Our job is to isolate the authenticated facts and build the analytical inference. We lead the legal determinations to the appropriate authorities.
Which brings us to our final section, Part 6, Actions for Oversight. With this investigative framework in mind, there are 3 practical actions that boards, CFOs, and compliance teams can implement immediately. Number 1. Accept that compliant paper isn't operational truth. A perfectly signed contract just proves a signature exists. It doesn't prove when the actual work began. Number 2. Watch the metadata, not just the raw numbers. Recurring transfers labeled miscellaneous, coming from a related entity, form a pattern. Investigate the pattern, don't just blindly accept the explanation. And number 3. Actively cross-check across domains. Physical access logs, banking metadata, and internal ledgers rarely lie in the exact same way at the exact same time. Comparing them is precisely how you expose the gap.
Because as this composite case illustrates, systemic breakdowns rarely announce themselves. Controls don't usually fail with a bang. They fail quietly, for years, until someone finally bothers to cross-reference the data. So if you oversee risk, compliance, or investigations, reflect on your own reviews. What's the smallest anomaly? Just one single log line, one strange bank comment that ever pointed you toward something much bigger. Because more often than not, that is exactly where the truth begins.
Simvansky Labs and Research. Forensics over fiction.